Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Welcome back to TFR for another edition of Investor Stories. On this segment, the experts talk about a startup that failed and the causes of that failure. Here's the segment called Mortems.
On today's special segment, we have Matt Cohen of Ripple Ventures. Matt, can you tell us a story about a portfolio company that failed and why it failed?
There is one portfolio company that failed, and it was really just because the founder did not want to take advice from any of the investors. They thought they had all the answers. And even when it was still not working and we were just there and saying, look, we're on the same side of the table here. You already have our money. We've already invested. We're just trying to get this thing to a viable business state. They still wouldn't adapt. They still wouldn't, hire the right people. They would spend money frivolously on things that, we didn't think they needed to, that they could have done internally. And at the end of the day, the founders just gave up and didn't want to continue to support them. And we had to sell the company. And so that was a tough one because we judged the founder wrong at the early days. And we've learned from those lessons. But trying to understand a founder early on before you've invested is a hard skill to have, but is an important one, especially at the early stage of investing.
On today's special segment, we have Yanev Suissa of SineWave. Yanev, can you tell us a story about a portfolio company that failed and why it failed?
I've seen a lot of companies fail because they don't recognize the difference between technology and product. This particularly happens when you have a lot of the very techie founders who fail to realize that, you have to productize this, right? The customer wants the tech capability, but they want a product out of this, which has a lot of different features and bundling. And so that's where I see things fail the most. A funny one, though, that we were in that did not fail, but that was one that I thought was not, that was like, whoa, these guys came in and like, who's pitching me here? Was Jump Bikes, which is one of the deals we do. We actually help them get a monopolistic right to operate from the government of San Francisco, which got them bought by Uber. But when they came in, I was like, who cares about these electric, blah, blah, blah. I was like, what is going on? The entrepreneur, Ryan, who's now a very good friend, I was not so thrilled on, but then I got in the parking lot and sat on the bike and I was like, wow, everyone's going to do this. And so we invested. And so sometimes entrepreneurs should think about how they present the product to the VC. There's certainly ways to get more interest.
Was the first instantiation of Jump Bikes, was it electric bikes or just the bike share sort of concept?
No, Jump has always been electric. They've always had that unique technology, which is still different from the electric bikes out there today. And I think they're phenomenal. And for us, they did well. They sold to Uber early, but for a great price. And that was great returns for everyone around the table.
On today's special segment, we have Rob Go of Nextview Ventures. Rob, can you tell us a story about a portfolio company that failed and why it failed?
Yeah, we were invested in a company called Boundless, which is a company I just love. It was a company that was trying to use open source content to attack the higher ed textbook industry. And the thesis was like, look, there's a pretty big industry out there. All of the information is available for free on the internet. But meanwhile, these publishers keep on making tiny revisions to these editions, making students buy full price books. And you have a decision maker who basically doesn't bear the economic cost of it. And so they just keep on assigning these expensive textbooks. So that was the premise. Amazing team, built a fantastic product. We got a lot of users, but we could never make any money. Most people think that company failed because we got sued sort of into oblivion, which we kind of did. But really, the reason we failed is we misunderstood the product we were selling. We thought we were selling a media product. It turns out we were selling an insurance product. Most students bought the textbook not because they valued the content, but because they wanted to make sure they have it just in case the professor, asks them to use it. And so when our model was like, let's give this away for free, we're going to monetize their engagement. But it turns out students do not engage with this thing. It is not a media property. It is just the comfort of knowing that you have it and you did what the professor told you to do. And so there was a fundamental misunderstanding of what the product was that we were offering students.
Interesting. I guess the studious folks that have their nose in the book and read every chapter may be the exception instead of the rule.
It is the exception. What ended up happening, actually, and which is why like Chegg is a real company, is the whole market did eventually move into this direction where there are a lot more digital tools, and there are all these like supplemental products that are offered to students that actually do a job, right? Like is more than an insurance product. And so we could have been this awesome top of the funnel for like tutoring, note sharing, these other like ancillary services that actually could bubble up to be a pretty big business. But we were just a little bit late, and we were a little bit wounded as a company because of some of the legal troubles that the business had.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Also, if you'd like updates on new content from TFR, as well as the top 10 VC articles every week, go to fullratchet.net and sign up for the newsletter. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.